Hi, it's Bob Hubescher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. On October 24th, 2022, precisely a year ago, we published an article by Allan Roth in Advisor Perspectives that was titled "The 4% Rule Just Became a Whole Lot Easier." And the idea for that article came from a conversation that Allan and I had, and I noted that real rates, as expressed by tips, at the time were about 1.75%, and I thought it would be possible to lock in the proverbial 4% safe withdrawal rate using tips. And Allan did the analysis. He found that indeed you could lock in a 4.36% safe withdrawal rate at that time. The article received widespread attention throughout the financial media, and perhaps it even had a role in the introduction of BlackRock's new suite of defined maturity tips ETFs, which is the subject of today's podcast. My guest, Dhruv Nagrath, will discuss the story behind BlackRock's new ETF products. He is the director of fixed income strategy at BlackRock. Dhruv, let's start with your career journey. How did you get into fixed income? What led you to BlackRock? And tell us more about your role there now.
Sure thing, Bob, and thank you so much for having me. It's great to be here with you on the podcast. So I have to say, Bob, I actually got into fixed income kind of by accident. So I started my career as a lawyer. I was a litigation attorney, and at the stage in my life where I was practicing, I realized I wasn't quite loving the work I was doing. I wanted to think a bit more big picture and a bit more macro, and so I started looking at other jobs and I basically stumbled into the job at BlackRock. It was through a friend of a friend who introduced me to my manager who hired me to BlackRock, and that person really took me under his wing and gave me a love of the markets. And so, one thing I'll share with you is as a guilty confession. Hopefully, this is a safe space. That very first interview that I did with John, my manager. Um, I later learned that I absolutely nailed that interview. I aced it, except for one question. And his question was a challenge question on duration. That I find that very funny because I'm now applying my trade as a fixed income strategist. But anyway, since joining BlackRock in 2014, I've since been able to get my CFA charter and of course figure things out in the fixed income side. And then at the end of 2017, got the opportunity to move over to BlackRock's headquarters in New York City, which I now call home. So yeah, look, it's been a great journey over the past 4 years, especially. I've really focused on the fixed income side of our business. And it's been a pleasure to be part of the growth of bond ETFs. I do think that they are transforming bond markets for the better.
Well, this is a safe space other than the several thousand advisors who may be listening to this podcast. So I want to talk about your the iShares iBonds TIPS ETFs that you recently introduced. Before we get into that, just provide an overview of iBonds.
Yeah, that's a great place to start, Bob. Look, the iBonds suite is one that we're really proud of. It's basically a way of helping advisors do what they otherwise do with bonds, but do it in a more scalable way. And what I mean by that is iBonds are term maturity ETFs. They trade like stocks and they diversify like funds. These are benefits of the ETF, but they have one more benefit, which is they mature like bonds. So trade like stocks, diversify like funds, and mature like bonds. So you basically get a bond-like experience with the benefits of a bond ETF. So we launched these products, this suite of products, actually back in 2010. So we've actually got a 13-year history of running them. We've had 30 maturities, and it started with munis, IG corporates, later on high yield. In 2020, we did treasury I bonds. And then recently, in the past month or so, we've actually launched TIPS I bonds. I say we're proud of the suite. I think overall we've got about $24 billion in assets under management across those different ranges. And it's been a strong year of inflows. Year to date, we've been seeing it's about $6.5 billion in year to date. And look, at the heart of it, it's basically the idea that you can scale your practice by having these portfolios of bonds that mature on set schedules, as opposed to having to build bond ladders with individual issues, right? You can do it in a scalable and modular way using the ETF structure.
Let's dive into I-bonds, TIPS ETFs. These are the first TIPS defined maturity products. Why did you launch them now?
Yeah, it's a great question, Bob. I think there's two things that I'd call out. One is based on looking at the product suite itself, and then two is based on the market environment. So just dealing with one, I mean, I think in the previous question we discussed the different ranges of suites we had across the product set. We have munis and nominal treasuries, IG corporates, and high yield. The reason that we thought of launching TIPS is to really kind of complete that product set, right? To give you the most kind of precise and useful toolkit that's possible, right? From an investor perspective. The market context, that's the second reason that I'd call out, is if you look at the way that real rates, which is the rate of the cost of borrowing basically in the economy after you take away inflation, real rates have moved up pretty significantly over the course of this year. Of course, that's been challenges in portfolios. The level that we've reached to, real rates are somewhere near the highest levels they've been in over 15 years. I think the most recent, the 10-year real rate is at about 2.44%, right? So that's a lot higher than it has been for a long time. So tactically, for some investors, this might be a good time to add in some exposure to real rates. But there's the other kind of reason that you think about buying TIPS is, of course, the inflation adjustment. And of course, inflation has come down significantly from that, post pandemic high that we saw. But I think there are arguments to say in the market that inflation could be a bit stickier and a bit more persistent than it has been in previous regimes, right? So because of that greater kind of macro volatility, and because investors are looking to build out well-diversified bond ladders that have some degree of inflation protection in there, we thought it would be a useful tool to add to the toolkit.
So the reasons are the increase in real rates that makes them very attractive, plus the ability to hedge against inflation, which, as you mentioned, is still potentially sticky and may be higher than the historical levels for some time. I mentioned in my introduction that advisors could have built a TIPS ladder a year ago and gotten a 4.36% 30-year safe withdrawal rate. Today, I think real rates, as you mentioned, are about 2.5% across the curve, and you can get a safe withdrawal rate of about 4.75%. Are advisors using these ETFs to build TIPS ladders?
Yeah, Bob, I mean, I would like to think that that's going to be the direction of travel. Obviously, we launched these products relatively recently, just in the past month or so. And so we've seen some pleasant little kind of inflows into the products, not quite the same magnitude as we've seen in the treasuries and the investment grade corporates. If you look at flows into those product sets, it's been about $3.2 billion into the IG corporates, and about a $2.8 billion into the nominal treasury I bonds. It's still early days for the TIPS I bonds with about $14 million in inflows since launch. I think the overall suite in total is about 33 million. So it's early days, but I do think that as more and more advisors become aware of this additional kind of tool in their toolkit, that they'll be kind of adopting it. That's our hope, and that's indeed. I mean, the initial response I'll share is that that there are a number of clients who've said to us, "Oh, this is great. We were thinking about this. We were asking this, and I guess one of the pleasing things about my job as a product strategist at BlackRock is I get to speak to folks like the ones who are hopefully listening into this call all around the country. And when you get that kind of direct feedback and clients say that, hey, this is something that could help us, it's a pretty good feeling.
So the key benefit is that you can construct a ladder by using these ETF products versus going to a broker and buying individual tips, which is not a simple process. And for that, the expense ratio is only 10 basis points. One of the benefits of tips is that they're exempt from state taxes. Is that still true with the ETF?
So yes, that's right. So the treatment of the ETF is going to mirror what the treatment of the underlying security is. Yes, it's seen as like a pass-through instrument.
So, what are your plans for the future? Are you going to offer I bonds for longer maturities, and will you offer a pure ladder to tips ETF?
So, Bob, I would love to be able to say with full clarity and transparency exactly what we're going to launch in the future, but of course, I'm not allowed to do that. But what I will say is that if you look at the way that the product set, the iShares ETF product set, has really evolved over the past 21 years of running and offering bond ETFs, the idea is to constantly evolve to meet client needs, meet clients where they're at in terms of their portfolios. And we really do think that bond ETFs globally are going to get to $6 trillion by 2030. And that's a pretty pleasing journey. It took 17 years to get to $1 trillion globally from 2002 to 2019. The next trillion came in 4 years, so it's kind of a pretty exponential rate of growth. And we think that really solid growth is going to continue, based on how we see advisors really revolutionizing how they build their portfolios. So I think that's the best I can put it.
As someone who has followed the tip space for almost 20 years and who knows the market for financial advisors, I recommend that you offer a tips ladder. It would be a great solution for advisors. You meet with clients all over the country. What are you hearing from them?
I think the best parts of my job really is to get to hear from clients and what matters the most to their portfolios. I'd call out two big things. The first question is the most pervasive, most important question in client portfolios, and it's funny because it harkens back to your very first question to me, is the question of duration, right? Rates have moved higher this year. They've continued to march higher. The 10-year breached 5%. The Fed has had to maintain a pretty consistent line on targeting inflation, and although they've made some progress, one of the tricky things for them is just that the U.S. economy is continuing to be a lot stronger than expected. Right at the start of this year, there were a lot of people that were expecting recession by the end of the year, and indeed, it's kind of gone the other way in that the economy's been resilient. Jobs are looking still kind of consistent, kind of being created every month. So that question of when do you add duration to the portfolio, we've had some clients adding it in. We've had some clients a little bit more wary, especially in the context where at the short end of the curve, they're clipping a pretty healthy coupon, so they haven't had to extend out. The view from our investment strategy team internally at BlackRock is that when you get close to the end of the Fed's hiking cycle, and we do think that we're pretty close to that end, as far as the data tells us now, yes, there's pricing for maybe another potential hike in December. There's some market probability around that, but we do believe we're close to the end of the Fed's hiking cycle. That becomes a time to think about what do the next 12 months look like. And so, our investment strategy team has been calling out opportunities in the belly of the treasury curve as a way of adding a bit of intermediate duration. So that's been our take on it. But I definitely do get a multitude of views. So that's point one, Bob. I'd say just the duration question is something that a lot of clients ask us about. The second one is on the topic of tax loss harvesting. Now, this is something that a lot of your clients, a lot of our clients are very familiar with on the equity side. But on the side of fixed income, it's not normally been a thing. But I think with the real rapid lurch higher in rates that we've seen over the past couple of years, there's been opportunities to harvest your price losses, right, on your bond funds, even if they might be positive on a total return basis because of the coupon income, the price return provides an opportunity to tax loss harvest. So, that's something that we talked to a lot of clients about last year. And you'll recall, Bob, the ag was down 13% last year, which is a pretty painful year for bond markets. But we actually saw just under $200 billion inflows into bond ETFs last year. And a big reason for that, thematically, was this idea of tax loss harvesting. The ETF becomes a really liquid, super efficient vehicle for enacting those trades. So two big ones, duration and tax loss harvesting are the ones I'd call out.
Let's talk about some of the other introductions, product developments on the BlackRock side. One of the biggest trends lately has been in active ETFs. You recently launched a new active fixed income ETF. It's called the BlackRock Flexible Income ETF, symbol BINC. Give me an overview of the fund and where you see it fitting in portfolios.
Yeah, this is one I'm particularly excited about because this is a chance to kind of do what I was referring to earlier on, which is kind of meeting clients where they are. And a lot of our clients are telling us that they like the idea of having active management, but they would prefer to have it in an ETF wrapper. Not for everyone. There's different ways to do it, but that is definitely a trend that we're observing, especially with the rise of model portfolios and ETFs being the basis of a lot of that portfolio management. So what we did with the BlackRock Flexible Income ETF, BINC, is that we created an ETF that's managed by our fundamental fixed income team, our active portfolio managers, led by Rick Reeder, who's our CIO of fundamental fixed income. So it's a portfolio management team run that runs that product. And the idea is to do something quite differentiated in the way that it's providing income to a client's portfolio. What it does is it operates in the part of your portfolio that's the spread sectors, right? So if you think about core and core plus, the areas that kind of make up the plus space, right? So thinking of things like high yield and emerging market debt and CLOs and securitized assets. These are areas that there are some clients out there who I meet who they don't want to make a call on the relative value between these things. That's kind of been where a fund like this can really fit in. It has the flexibility to kind of go anywhere within those spread sectors, and it's got a hard cap on the areas that make up the core part of the ag. It's got a hard cap of 20% on those areas. So the idea is this is by definition a spread sector product, with the benefit of the active management of Rick Reeder and his excellent team to really to help you navigate generating income. And obviously, as we know, based on the past couple of years, the income generation kind of opportunity set is just so much greater than it was before, right? So it's a real chance for them to kind of add value in that space.
Bink has nearly 900 holdings. I looked last night. It has an expense ratio of 50 basis points. Why do you believe it can outperform the ag by at least those 50 basis points, given that it will be such a highly diversified ETF?
Yeah, so Bink is actually benchmarked to the Bloomberg Universal benchmark. And by the way, I'll share that it has a net expense ratio right now of 40 basis points, so with the fee waiver. The reason that we think that Bink is positioned to kind of add value in that space is because if you think about the nature of each of those sectors, they are riskier sectors, right? This is playing in areas like emerging markets where it takes considerable amount of nuance to understand the varieties of the different securities that can go into an EM debt index, or even high yield debt, right? Making sure that you're kind of aware appropriately of where are you allocating risk, as we right now have, as I said earlier, on a firmer than expected economic environment. What does that look like next year, right? So knowing that you have the kind of the bottom up security selection, the active resources of that team, that's an area that we believe that these portfolio managers have the ability to kind of add a bit of extra value, and we do think that there are clients out there who want that extra degree of discretion. I will say we haven't put a stake in the ground in one side of the active or the index debate. We don't believe that that's a debate anymore. We think that really efficient portfolio management has elements of both. You've got really like low cost, super efficient exposures on the index side, and then when you've got active management that seeks to add value and do something differentiated on the active side, they can work really well together in a combination. We call it the BlackRock bond barbell, but I know we use the barbell analogy a lot in different places in the bond market, so I won't overdo it.
You mentioned earlier that you've heard from clients that they prefer active managers or active management in the ETF wrapper. Why did you choose an actively managed ETF? What were the trade-offs that you considered versus an open-end mutual fund?
By the way, it's not all clients. I think there are some clients who still love the mutual fund structure, and there are some benefits to the mutual fund structure, the traditional active mutual fund structure, in terms of being able to do certain things that can't be done in the ETF, just by virtue of the nature of liquidity requirements, etc. But where I think we've received feedback from clients that they do want to get the active management within the ETF is in that model portfolio space, right? We've seen a lot of clients shifting their portfolios to more models-driven practices, and as I'm sure you're very well aware, Bob, from the clients that you speak to, ETFs have been really at the core of that, right? In the way that the assets are custodied at the different custodians, the way that there's transparency into daily holdings. Bink, for example, it's a fully transparent, daily transparent ETF, right? So there's a lot of benefit that comes from the liquidity, the easy trading, and the transparency. Those clients who are building those model portfolios, that they see that, and they've kind of asked for it. So I think that it's those rise of those models that's been a big driver, and we've seen clients really kind of adopt the structure.
Where else are investors turning for income?
In the space of in the overall theme of our conversation, Bob, where we've been talking about product development and innovation, we're really proud of something that kind of we did about a year ago, which is to launch an industry first in the industry with buy right ETFs. So these are covered call strategies, which I'm sure your listeners are very familiar with on the equity side. They've been, I think advisors have been aware of and doing covered calls for years and years, where you hold an underlying asset and then you sell call options on that asset to generate present income, right? Now, you're obviously making a trade-off there by doing that, because you're giving up some upside potential in exchange for present income, and you're kind of rewarded by the option premium you generate. So the reason that we did an industry first is that there's a very healthy options ecosystem that has developed around some of our largest and most liquid fixed income ETFs. So HYG, LQD, and TLT. If you put a W on each of those tickers, you get the equivalent buy right strategy versions of those. What we've basically been able to do is to offer all those the structural benefits of using a buy right strategy, which is, namely income, but also taking a view on the direction of the asset, be able to put it in an ETF wrapper, right? And so we've seen some really pleasant kind of growth in the products. We've grown over $800 million of inflows in the first year of assets across the suite. A lot of that's been going into TLTW. That's been a really popular and interesting one. But the other two have also grown to some extent. And just to be clear, we are rolling options on a kind of a monthly basis. So you're not getting called away on those options. And I will say the income has been, looking at the past 12 months, like the trailing 12-month yield on TLTW, for example, it's up at around 19%. So that the income generation piece, you asked me where investors turning for income. That's been, I'd say, front and center, the number one way that we've had clients trying to figure out income.
So basically, this is like a covered call strategy. You're selling options against a core bond holding, and using the proceeds from that sale to generate income in return giving up some of the upside. The success of that strategy will depend on bond market volatility. The greater the implied volatility, the more option income you'll receive. If your fund has a yield of 19%, some of that may be because the implied volatility has been high. What guidance do you offer to advisors who are concerned about this dependence on volatility?
You're right in identifying that, like, that level of yield is a very high level of yield, right? Realized yield based on selling those options. The way that I'd speak to those advisors is to say that there are going to be high vol environments, and indeed the past year has been an incredibly high volatility environment, and so that has then been rewarded by selling of those options. But there are going to be periods where volatility comes down, and so the additional income that you generate from selling those options is not going to be as high. That's a very important thing that we really, any client conversation we have about this, we do talk to clients about, hey, this is about managing expectations, not just for yourself, but then for your clients who you are putting putting these products in their portfolios. It's managing those expectations. So there's two ways that I'd think about using the buy right strategies. One is you could just use them as a strategic holding in an income generating portfolio and recognize that there are going to be some market environments where the income generation from the options is high, and then there are some times where the income generation is low, but on average it's adding a bit of incremental income above the income that you're getting from the underlying ETF as well. That's one important point to make, is that you're still getting the underlying income from the underlying ETF. So that's one way, right? The strategic hold. The other one, for the more sophisticated kind of portfolio constructors amongst your listeners, is where if you're getting a bit more tactical and you're saying, I have a view that my underlying asset is either going to go sideways or maybe fall in price, that having a bit of income, a bit of a buffer from selling those options can maybe be a way of outperforming just the underlying, right? Now, you have to take a view, right? So, for example, if your underlying asset is going to rally, then you're going to underperform, right, by using the buy right. So, look, like I said, there could be some strategic holders and there could be more tactical holders.
Let's come back to the original topic that we discussed about your defined maturity ETFs. If there's one key takeaway that you'd like to leave with our audience of advisors about how they should use those defined maturity tips ETFs to help clients achieve their financial goals, what would that be?
Yeah, Bob, I appreciate the question. I think the biggest takeaway is that you now have the ability as a financial advisor to add a layer of inflation protection into your construction of a bond ladder. And so you've got a more precise toolkit, and you have the ability to kind of layer in some protection for inflation being higher than expected, right? And as we go into a more potentially more volatile macro environment and maybe have more sticky inflation, having that tool in your toolkit is a pretty handy thing.
Wonderful. Well, we'll include some links in the notes that accompany this podcast. I'm going to include a link to two articles that Allan Roth wrote. One is the one that I mentioned, The 4% Rule Just Became a Whole Lot Easier, and a more recent article that he wrote, A Case for BlackRock's New Defined Maturity Tips ETFs. There's also be a link to a Wall Street Journal article that just appeared about using tips ladders. There'll be links to the iShares, iBonds, Tips ETF website, a link to BlackRock's Flexible Income ETF BINC, and a link to the Buy Rights suite that BlackRock offers. Dhruv, is there anything else you'd like to add?
No, I just like to thank you, Bob, and Advisor Perspectives and Verify for having me on the podcast.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hubescher, today featuring Dhruv Nagrath of BlackRock. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.